Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Tariffs, they're back on. A U.S. federal appeals court siding with the president, reversing a block on part of his tariff agenda. Meanwhile, Treasury Secretary Scott Bessent warning that trade talks with China have stalled. And a proposed tax measure in a U.S. tax and spending bill would increase tax rates for individuals and companies from countries with, quote, discriminatory tax policies, potentially driving away foreign investors and threatening trillions in assets. And Federal Reserve officials say the U.S. economy is in a good place, but right here in Europe, focus is on inflation. Data due out of Spain, Italy, and Germany over the next few hours. Guy.
So I don't know whether this Friday morning, whether it's just a kind of rabbit in the headlights or exhaustion, but markets are doing nothing this morning, absolutely zero. Stoxx futures, Stoxx 50 futures here in Europe are slightly up. S&P futures are slightly down. You could argue that this lack of a sense of direction is pretty alarming, particularly given the recent rally we've seen in equities. Is that now running out of steam? Is the news flow beginning to turn against it? Euro dollar is pretty calm as well. We've got a 113.48 handle. Dollar yen is actually the most interesting space, I think, this morning in so many ways. You look at the inflation data that came out of Tokyo overnight. Hot tells you that basically the BOJ is likely to keep pushing forward in terms of rate hikes. That has global implications. But broadly at the moment, I think people are kind of trying to figure out what out of a huge range of catalysts we have out there could be the one to focus on. Anyway, we're going to try and figure that out over the next couple of hours. The opening trade starts right now. Good morning, Friday morning. What are you focused on this morning? What is the top story that you need to be thinking about in terms of what is going to drive markets forward from here? Because at the moment, and I've just shown you the board, there doesn't seem to be a clear sense of direction that is emerging. Is it the trade story? But which trade story? Is it this tax story? How do you think about that? What is the implication of that for US assets? What is the story around the earnings picture? There's so much, Kriti, to think about this morning. But let's start with the trade narrative, and then we'll go from there. So the market rallied yesterday on the idea that this is off. This is not happening. We're not a big rally, but it was a rally of 1% for the S&P on. It closed there, sure. Yeah. But futures overnight had a bigger move, so there was an expectation that this was positive news until the narrative changed, and lo and behold, we got exactly what everyone expected, which are there are other ways to get around a trade court ruling, talking about an appeals court that's now siding with the president. He's also talking about including it in various other ways. We're still waiting for pharmaceuticals. We're still waiting for the tax bill. We'll dive into that in just a moment as well. But I thought it was interesting at the same time, you have Scott Bessent saying that those trade talks that we touted, what was that, 2 weeks ago? Yep. They're not as positive. Those talks aren't as positive. Here. Yes, weren't as great as we all thought. The focus now in Japan, there's a few different coals in the fire. There are irons in the fire with the coals. Something is burning. Something smells. In terms of where the heat actually is, though, as you say, the China story is cooling, and you can understand why. You look at what is happening with the university story and the foreign students. I think that's a factor that the Chinese are going to be thinking about. There's kind of more chip restrictions being imposed. The Chinese are facing non-tariff barriers coming out of the United States, and I'm wondering if that is forcing them to recalibrate and think about what they're going to be doing. Bessent basically says, I need Xi and I need Trump to be able to sort this one out. Maybe I've gone as far as I can go on this one, which I think is really interesting. The Japanese story, I think, is going to be fascinating later. I think Bessent's meeting the Japanese delegation a little bit later on today. Yeah. He's hinted at progress. It was a TV interview in the States in which he hinted at progress. Are we going to see any evidence of that today? I don't know. But it does seem as if the optimism that we've seen over the last kind of 2 weeks definitely beginning to fade on the trade front. It's fascinating as well you mentioned the Japan story, because if the Harvard and the foreign student visas was the way to maybe get at China, or at least maybe re-escalate tensions with China, the opposite is happening with Japan in the form of the U.S. Nippon Steel deal, and that a complete 180 from the Trump administration, something that actually Trump and Biden were both aligned on, is that we don't want the Japanese investment into the States. That is completely turned around. Not only is there a big kind of cash flow coming in, but that idea of national security no longer applies to the Japanese. And that is a positive, an olive branch, perhaps, ahead of these talks. It's interesting that the Japanese, the narrative out of Japan is beginning to go, have we given too much away here? Are we actually kind of acquiescing too much to get this deal over the line? And I wonder whether it's a done deal in the way that maybe the headlines suggest. Let's talk about the markets and kind of the market reaction for the last 48 hours. I think has been fascinating. Yes, this time yesterday we were looking at NASDAQ futures up by 2%, S&P futures up by 1.5%. We did not close there. We closed up 0.4% yesterday. In theory, you could argue yesterday was a good news day on tariffs. Now, normally we go down on kind of bad tariff news and we then more than compensate on the upside. Yesterday we got some good news on tariffs, theoretically. I know what you're going to say next. But we didn't react strongly in terms of the equities. What is the signal from that? Is that a worrying sign? I think Cudmore's written a piece. I think Cameron Cry's wrote a piece as well, talking about the fact that markets tend to top on good news, not bad news. Was yesterday an example of that?
I think it's a great point, because I'm comparing this to what you had mentioned last week when it came to the EU trade deal and the fact that you had this 3-day chart that kind of showed this dip on the news and we came right back up, and it felt like nothing had really changed in the 24 hours from a market narrative sentiment. Yep. We're having the same reaction, right? It's the same thing where we've had a complete 180, a complete reversal in the news, and I think investors are looking for a place to buy, even though I feel like the narrative you're still hearing is that American exceptionalism is on the decline, the valuations are still too high, we don't want to touch it, except yet someone's buying into this market. I just don't know who. The
theory has been that it's been retail. But the last 24 hours, I've read numerous articles about the fact that there are signs emerging that retail is becoming more nervous. If retail is the buyer of last resort here, kind of is that buyer of last resort beginning to have second thoughts? And I'm just kind of, if that's the story, then you want to pay attention to that and really think about it. Let's talk about this. Section 899. We're calling it the revenge tax. We're calling it the Treasury tax. I don't know. This is a tiny part of the tax bill that has gone through the House. I wonder whether anybody read it. And
I'm sure someone did.
I'm sure somebody did.
Some staffer.
Maybe in the Senate, but and now they've woken up and maybe decided to tell everybody about it. Then it goes to the Senate. And basically the idea here is that if you are a country that has a digital sales tax, your institutions and your investors could end up facing a higher withholding tax effectively in the United States as revenge for having that tax in your home country. Now, the US stock market relies on foreign investors. The US Treasury market definitely relies on foreign investors. If you're taxing my dividends and you're taxing my interest, am I going to invest as much money into the United States? Just at the point in which the United States needs that investment. So this is certainly, I'm seeing a lot of interest in this story, quite arcane, but really important.
Really important. I also think it's interesting because, and our story covers this. We're talking about passive income, things like interest and dividends. Now, interest makes sense. You see it on the bond market, fine. The dividends piece is what really struck me, because if you actually look at the way that the stock market and corporations are returning capital shareholders right now, it's in the form of share buybacks. And the idea here simply is they're sitting on tons of cash. The market is selling off. These corporates are stepping in. Makes sense. You're seeing it right here in Europe as well. But if there is a recessionary case, how many times have we had people on the show come and say, well, the minute the buyback stopped, that's the red flag when it comes to the earnings, alongside
maybe that's the buyer of last resort.
That's the buyer of last resort. But then also the idea that if you do have that pullback in buybacks, a lot of corporations in previous recessions have switched to dividends. Like, that has been the alternative to doing that. But what if there's no buyer for those dividends? And this is what this tax bill kind of talks about in the worst case scenario, that suddenly this idea that your structural kind of reinforcement of exposure to the United States maybe isn't so structural anymore.
Well, it isn't. And you're now fighting a weakening dollar, which is another headwind, which is another factor. You've now got better options elsewhere, potentially. Europe is looking stronger. Like, how long that lasts for, I don't know. But in theory, there is a fiscal push here that is going to drive investment back. You've got a Japanese story. Today, look at the inflation data out of Tokyo. Inflation's going higher. The BOJ is going to raise rates. You're getting a better return on your JGB, so is money going to come back as a result of that? There are other alternatives. Previously, there was no alternative to the United States. There are now other alternatives, and this makes it better.
Like what?
Well, I invest in Europe. Europe equity markets are outperforming.
Sure.
Invest in JGBs. They're looking better. The yield gap is closing. There are alternatives. It only needs to be at the margin.
That's true. That's true.
And that's the point, is that the US has sucked in all of the capital. Its asset markets are based on the fact that that capital is going to remain permanent. If it's not, or even the marginal extra new dollar doesn't go in, then that's a problem.
And now to your point, that was the kind of idea that you're deleveraging from the overexposure to the States. But this takes it further than that. This says you don't need to go back to neutral. You can actually, in theory, I don't know if this is the consensus, but underexposed.
Yeah. And that's a problem for US assets, which are heavily reliant on that capital flow. Jeff Yu's going to be joining us very shortly. We'll get his take on this. BNY EMEA senior strategist Ignacio Garcia Burco is going to be joining us from Bruegel, non-resident fellow. Talking about trade. What does the trade story coming out of the States mean in terms of how the Europeans need to negotiate? We'll talk about that with him a little bit later on. Delphine Arnault, Edmund de Rothschild's multi-asset portfolio manager, is going to be joining us as well. And Carol Nackel, Crystal Energy CEO, is going to be joining us as well. We're going to be talking about the upcoming OPEC meeting. What do we know about oil prices? Where are they going? We're going to find out.
Fascinating conversations on the program ahead. A couple of the data points to keep on your radar as well. At about 10 a.m. UK time, those Italian inflation numbers are going to be hitting the wire, followed by German inflation later in the day. The regionals, of course, starting at 9 a.m. It's that overall print you want to keep an eye on coming up at 1 p.m. Just 30 minutes later, data out of the States begin. Personal income and spending, PCE. If there's a conversation here about cracks in that economic resilience of the States, today might be an early signal of that.
Yeah, claims are beginning to tick higher. Just keep an eye on that as well. That's something you want to be paying attention to. There's a number of different ways of looking at this. Let's start with the European Central Bank. We've done a survey. The sense for economists is that the ECB should be cutting twice more from here. But actually, I think the mood music is beginning to emerge from the ECB that those cuts could be later in the year, because basically the ECB, a bit like the Fed, wants to wait and see what happens after the 90 days, wants to know what happens with this trade story. They should probably tune in a little bit later. We've got a great trade guest coming up. Maybe they'll learn something if they watch this show. So maybe we don't get imminent ECB cuts. The summer is going to be really difficult, I think, for the ECB. Later in the year, maybe a little bit more clarity. You've also got the Fed under pressure as well. I think the Fed story is fascinating. Trump's talking about the fact, he had Powell on the sofa yesterday chatting to him. You should be cutting rates. But the Fed's like, we don't know yet. So we're going to wait.
Insurance cuts are unfashionable. I thought it was fascinating. This is the first meeting between Jay Powell and Donald Trump since November of 2019. What happened in March of 2019? Just a quick history lesson for everyone. It was the insurance rate cut off of Donald Trump's trade war. You hadn't had the hard data show up yet.
Yep.
You hadn't had the tariff impact just yet. But there was such a concern from the Federal Reserve that would exist and there would be this kind of cliff dive in the economy that they cut rates. And I think that's the argument Donald Trump is using here when it comes to Jay Powell. So you've done it before. You did it under my administration before. Yeah. Why not this time? And the answer is inflation.
Yeah,
exactly.
You got
We're
inflation.
on the same page this morning.
Salami. You got inflation. That's a big concern. So Powell's going, look, and I don't know yet what the effect of that is going to be. I don't know yet. I'm not going to, as you say, make a preemptive move, because actually the situation this time around is much more difficult and less clear. And as a result of which, like so many on the FOMC at the moment, he's just like, I need to wait. I need to make a proper decision based on proper information, and I don't have that. Anyway, again, a question for Jeff Yu. We'll be talking to him shortly. What else do you need to know this Friday morning? Harvard University has won a longer-term reprieve from the Trump administration's ban on enrolling international students. Harvard sued the administration last week, claiming the ban was illegal. Washington remains the Ivy League school. Washington maintains the Ivy League school failed to comply with the terms of its certification for enrolling foreign students. Separately, on Thursday, the United States moved to start revoking visas for Chinese students with connections to the CCP, the Chinese Communist Party, or studying in critical fields. Bloomberg has learned that Apollo is partnering with JP Morgan, Goldman Sachs, and 3 other banks to trade private credit and syndicate investment-grade debt. Sources tell us the partnership will allow Apollo to originate larger loans more quickly and support its efforts to reach individual clients. Apollo and other fund managers see the $1.7 trillion private credit market as still in the early stage of its explosive growth. And Dell has given a profit outlook for the year that exceeded what Wall Street was expecting. The company says AI server demand is unprecedented, with more than $12 billion in orders last quarter alone. That number exceeds shipments for the entire prior fiscal year. By way of context, Dell says the AI market is exciting, but also lumpy and with a highly complex supply chain. Yeah, I think we're all beginning to realize that.
We are. Dell's one story. I want to quickly talk about Costco. We talked about yesterday about
I don't know how you get from Dell to Costco, but
earnings, American companies, close enough. It's Friday. Give me some credit. Costco, I thought this was interesting. I was waiting for some sort of tariff reaction. We didn't really get that today or
maybe they bought
yesterday.
in bulk. Maybe they haven't got it.
They're quite literally shifting their production. They're quite literally doing what everyone else is doing, which is they're advancing their orders, and that's a big part of how they're navigating it. And we heard it from Walmart. Now we're hearing it from Costco, and that seems to be
So here's my question. if the court hadn't blocked the original court's ruling yesterday, so my understanding is that tax authorities have been starting to process refunds. So how does it work? Does Costco get a refund at some point if this is thrown out? Can it then? Do I take my receipt back to Costco and go, no, that's tariffs. I want my money back, please. Well, I don't know how it's going to be fascinating to see how this works if it's thrown out, which at the moment it doesn't look like it's going to be.
Well, it's also fascinating because the way that, and I thought this was interesting, and I think the Wall Street Journal had a really strong take on this, is that because they're pulling ahead some of these advanced orders, it also helps them keep prices lower because they have the excess inventory. So that kind of idea that Walmart had, where they could see that sharp increase, doesn't exist for Costco. And at the end of the day, Costco has a little bit more price flexibility, whereas Walmart is quite literally the everyday low prices. They're dealing with the lower income. Costco requires a membership that you buy in bulk. You have to have a little bit more income to be able to shop there. And they're taking advantage of it, being able to navigate this a little bit better.
The membership thing is always kind of, yeah.
You're not a fan?
No. I'm just,
We gotta take the show on the road to a Costco, figure out what's going on. Coming up on the program, plenty of other stories to cover as well. Starting with the chair of Political Party Reform UK joining the show to outline his party's plans for crypto in Britain. Plus, OPEC Plus members head to their latest discussions to decide on those July output levels. How much of this tariff uncertainty is showing up in their thinking? But up next, we're diving right back into that trade turmoil gripping markets this year. FOMC members believing the U.S. economy is still in a fairly good place. What do you do with the markets then? We're going to dive into it. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Right now, monetary policy is in what I think of as a good place. It's where it needs to be to continue to bring inflation down, and the economy's in a good place. We have declining inflation, it's gradual, but it's coming down, and we have good growth and solid labor market. Those are the things that mean we have a reasonably good economy.
If you want to hold rates where they are, that is exactly what you say. The economy is looking good, inflation's coming down really slowly, don't have a problem particularly on the labour market, we are going to hold. If you are looking at a market that you don't know what's going to happen next, you need a narrative to justify where you are. And I think Mary Daly put it kind of exactly how you would put it if you wanted to maintain rates. I think it's a really interesting conversation about kind of what the messaging coming out of the Fed is right now. Jeff Yu, Senior EMEA Market Strategist at BNY, joining us around the table. Despite the great economy that Mary's talking about, there are cracks beginning to emerge in the investment case for the United States. You've got a lot of uncertainty, political uncertainty, legal uncertainty. You've got a bit of economic uncertainty beginning to creep in as well. You've then got this tax story we've been discussing as well this morning, which may impose higher taxes on foreigners holding assets within the United States. The argument about putting money to work in the States is getting a little tougher. May just be at the margin, but it's getting a little tougher. What are you seeing in terms of your flow data?
So in terms of the flows right now, what was striking about the Treasury market, for example, was that throughout, I'd say, mid-April and throughout the last few weeks, actually, if I look at the longer end of the curve for international investors, they're actually buyers of US Treasuries, 10 years and beyond, because suddenly they're seeing close to, let's say, 5% in various maturities, euro dollars at 115 rather than 105, 102. Yep. So from their point of view, and you've seen Asian currencies strengthen a bit as well, or at least hold the line. Value came in, but where the release valve, so to speak, I think has been the dollar. So still running sort of, with the US exceptionalism narrative, but something has to give, and probably it's just easier to hedge that dollar component for the time being. As you just said, more and more uncertainty, and now just towards month end, maybe a bit of rebalancing, seeing some slight profit taking on that side. But for the most part, the long end of the curve has been attractive.
Is the dollar the biggest factor right now?
I think the dollar is the biggest factor in terms of how you may want to hedge your risk in terms of all the other things on the policy side, on the trade side that people have talked about. And also, if this global trade rebalancing, does work, I think then by definition, the dollar will need to soften to some extent. The US, runs a slightly better, current account position in that sense. But at the same time, I think from international investors, they want to rebalance their own views as well. So the dollar, I think, is still the key factor here. How far does it have to go to compensate, for the other factors? Yeah.
Well, say it does go further, which is the consensus view at the moment. To what extent does euro-dollar, as simple as that, become a carry trade?
Well, here's where I think the ECB may have something to say about that, because the euro-dollar is, if you went to the last press conference, it sounded like they were quite forceful on euro-dollar's restrictive factor in terms of financial conditions. But now that may be stepping back a bit because some of the hawks are starting to come through again. It seems like monetary policy is in a good place in Europe as well. So they can use that to bring down European inflation, to restrain things, maybe relative value. That seems to name the game in FX right now.
So we keep saying that this is everything's at the whim of the dollar.
Yes.
But from what I'm hearing from you, it sounds like the ECB, if they cut whenever that happens, that's the trigger to reverse all of these flows.
So from euro-dollar's point of view, I'm slightly uncomfortable with euro-dollar valuations. I did have a parity called a couple of months ago. So, but now I think from their point of view is your trade rebalancing is still happening. You can't afford to have too strong a euro at this point, and European equity valuations are quite rich. From after the
Christine Lagarde's desire to have the euro be an alternative to the dollar in terms of reserve currency status. Does that work in the scenario, the picture you're painting?
I think from her point of view, and she was trying to get to this in her comments, a lot of that's more institutional, because when you start to question, let's say, the status of any currency, you talk about the institutional backing behind it. So then we need to bring back those issues surrounding a capital markets union, banking union, and the like. So that's sort of beyond her remit. But for the time being, we would still distinguish the level of a currency versus the status of a currency. I think those are different things still.
What is then, where did the other currencies fall into all of this? Because in this, you've also seen bids into the yen, arguably bids into the renminbi. The pound is on a tear, which I don't really understand, but where's the overvalued pieces of FX?
So I would say the biggest surprise in terms of AAA flow, so sovereign bond flow, Chinese government bonds, not AAA by the way, but Chinese government bonds have actually done very, very well in our flow data. Bunds have done very, very well as well. And I would say probably JGBs, bunds and CGBs, these are the three bond markets where higher yields are going to be seen as a positive thing, because that's, in Japan's point of view, normalization, but in Germany and China's point of view, pricing and fiscal, greater supply. That's what the entire international investment community have been asking for to boost growth. So in that sense, if you look at where yields are, they could go further. And if that's a sign of health, then maybe central banks will just sort of tolerate it.
Can I just come back to the compensating, the dollar compensating for everything else? Is it at 112, are we compensating for everything else?
It really depends on, what is the everything else, because there's so much uncertainty.
Exactly.
If the everything else, goes away, then if I look at implied volatility, that could surge again. We're just sort of normalising compared to April levels. It could go the other way, but I think, you often in FX markets, run into the situation where jumps in vol in the short term, that is, pricing various factors in, but then sellers of vol will come in to, try to take advantage of that as well. So just holding on to that kind of decay is often, quite painful within FX markets. So there's that technical component there. But the valuations, gradually, the fact that we've re-rated to some extent euro-dollar supposed fair value from around parity 1 to 105 to this 110, 115 range, I think that speaks volumes.
All right. Jeff Yu, Senior EMEA Market Strategist over at BNY, walking us through the various dynamics and where the story might change from the weakness in the dollar to perhaps some of the other catalysts around the world. We thank you so much. Coming up on the program, we're going right back to the Trump administration. Surprise, surprise, insisting tariffs are here to stay. One way or another, a legal battle looming over those levies. We're going to dive into the view from Brussels. Trade expert, former senior EU official Ignacio Garcia Bercero is joining us next to dive into what you do when you don't know what to do. In the meantime, futures are higher marginally. Stick with us. This is Bloomberg. Minutes away from the start of the opening trade. It is Friday. We do have a little bit of Friday energy, and futures kind of drifting higher. And especially when it comes to this European market, a different story over in the States, of course. But you are seeing outperformance perhaps in the FTSE 100. Your Stoxx 50 futures, though, Guy, flat.
Yeah, that's not exactly the world's most exciting board, nor is the next one. Let me just show you what's happening in the bond market right now. Not a lot to see here, as you've got an unch on OATs. You've got not much action in bunds. BTPs aren't moving a great deal, as you can see, either. This is not a strong start to the Friday. Is that what Friday energy is? Friday energy is no energy.
My
Like
Gosh.
Friday energy is I'm looking forward to the weekend. Should I have more energy or less energy? I don't know.
I think it depends on the
What your
job
weekend
you're
looks
in.
like.
Yes, and what your weekend looks like. For me, Friday energy is a little bit more chill, a little bit more wind down, which I think is what this market is reflecting. In the meantime, courts digesting some of the trade news and the developments overnight from the United States. A federal appeals court has temporarily blocked a ruling that threatened to throw out the bulk of President Trump's tariff agenda. Now this, as U.S. Treasury Secretary Scott Bessent says trade talks with China are, quote, a bit stalled.
Given the magnitude of the talks, given the complexity, that this is going to require both leaders to weigh in with each other. They have a very good relationship, and I am confident that the Chinese will come to the table.
Joining us now, Ignacio Garcia Bercero, non-resident fellow over at Bruegel and former director at the European Commission, where he led negotiations for the Transatlantic Trade and Investment Partnership. Ignacio, pleasure to have you on the program. Thank you so much for joining us this morning. Perhaps we can pose the question to you that Guy and I have been kind of racking our brain all week, really, which is, with these developments, what is the thinking at the EU? Given the volatility simply on the legality of this policy, what do you do if you're a trade negotiator with the United States right now?
Yes, I think we are going to be having a lot of uncertainty about what is going to be the final legal status of these tariffs. I mean, I think from the European Union point of view, it was always very clear that the tariffs are illegal under international law. Now it seems that they might also be illegal under U.S. constitutional law. Now, this being said, it is important to bear in mind that the issue between the United States and the European Union is not only the reciprocal tariffs, it is also the Section 232 tariffs, which are there. And therefore, my sense is that the European Union, the European Commission, will continue discussing with the United States to see what is the way forward. So from that point of view, I think that discussions are going to continue.
Well, Ignacio, talk to us about the goal here. I mean, we've heard from various European officials, but also just in terms of reporting, that the goal from the European Union's perspective is ultimately to remove tariffs altogether. No tariffs on either side, 0 for 0, and kind of have that agreement. That's been met with quite a bit of resistance from the Trump administration that wants that 10% universal levy. Is that still, or should that still be the goal from the EU's perspective?
Well, I mean, I think it's always important in negotiation to go with an ambitious goal. And then I think the reason why it was important that the European Union made clear that on their side there was no problem in terms of going for full duty elimination of industrial tariffs. At the same time, at this point in time of the discussions, it seems to be very clear that this is not going to happen. It also seems to be very clear that the 10%, if it stays, and it may well not stay, it is not something that this administration is ready to negotiate about. And therefore, the solution for the 10% is going to be litigation, domestic litigation, but if the domestic litigation maintains the tariff, then WTO litigation. So I think the main goal from that point of view, I think from the European side, should be the Section 232 tariffs, which are impacting on some sectors which are very important for the European Union, and which are threatened on other sectors which are also equally important for the European Union. So in a way, I think that's what the discussions should be focusing on. Can one find a satisfactory solution on the 232 tariffs? And what are other steps that both sides can do to facilitate their mutual trade? Because at the end of the day, it is in our interest to have an escalation of a trade dispute between the United States and the European Union. I think there are other challenges which are much more important in the global trading system, including the challenges relating to Chinese overcapacities or to Chinese subsidies. And it would be in our interest if this conflict was going to escalate. So from that point of view, I hope that now that the issue of the 10% at the threat of higher tariffs is a little bit off the table, that discussion can be focused on the things where progress can be made.
Ignacio, what is your current view on where we land? Where does this end?
Well, let me say that from my point of view, one could have a combination of four elements. One, it is clear that the European Union has an interest on phasing out imports of Russian LNG, and that creates a significant market opportunity for the United States. Secondly, there's always been a number of areas where the European Union and the United States could work together to facilitate trade. I mean, when I was negotiating the TTIP, there was a lot of discussions about mutual recognition agreements on sectors like the car sector or pharmaceuticals. There have also been a lot of discussions about mutual recognition agreements on issues like conformity assessment. So that's something where I think if it is clear that there has to be efforts from both sides, there can be progress. I think it's also true that the European Union is in a process of simplification of regulation. And some of the simplifications may also be helpful to address some of the concerns that the United States has raised on some European Union regulations. So I mean, there is an area where, again, the progress can be made. And last but not least, both the United States and the European Union have a concern about non-market economic practices of China. They have a concern about overcapacities, about the Chinese model, which generates macroeconomic imbalances. And these are issues which are not going to be solved bilaterally. I think it's very difficult to imagine that a bilateral negotiation between the United States and China is going to provide a stable solution to macroeconomic imbalances or to the problems related to Chinese subsidization. So I think, in my view, this is something on which the United States and the European Union could also identify ways to cooperate.
Ignacio, in some of the points you made, you talk a lot about this kind of economic diplomacy as well. A door, you mentioned LNG, for example, is one example, a door that Ursula von der Leyen has been knocking on that's kind of swung wide open. But talk to us a little bit about the stick approach in terms of if negotiations sour further than they already have, what levers does the EU have at their disposal to maybe bring the Trump administration to the table?
Well, as you know, the European Union has already agreed on a first retaliation package that will be applied automatically in mid-July if there is no agreement. This is a response to the tariffs that are being applied to steel and aluminium. The date of entry into force was postponed to give more space for the negotiation, but this is something which is already decided. The Commission has also now started consultations on a broader retaliation package, which is a response to the tariffs on cars, but also to the 10% tariff if these were going to stay. And I think there's a few more weeks before those consultations are concluded. What if the United States was really going to escalate the issue by bringing the tariffs higher than 10%? In my view, in those circumstances, there's an instrument which has not been used so far, but it's called the anti-coercion instrument, which would also allow for the countermeasures beyond tariffs in services or in procurement. So I hope this is not necessary, but it is very clear that if there's no negotiated agreement or if the United States decides to escalate the issue by bringing higher tariffs, there can be a very significant retaliation coming from the European Union. It is not going to be as broad as the one by the United States, but I think that there's really a stress on the weakness, because the more that you make the scope of application of your tariff broader, the more that you are hurting your own economy. So I think the European response is always going to be more targeted than this idea of applying the 10% or 50% tariff across the board.
We look forward to seeing how that all unfolds. Ignacio Garcia Bercero joining us this morning, the non-resident fellow over at Bruegel and former director at the European Commission. Coming up on the program, we're going to shift our focus to right here in the UK. Reform UK's Nigel Farage announcing a crypto policy at a Bitcoin conference in Las Vegas. We're joined exclusively by the party's chairman. That conversation coming up on the program next. Stick with us. This is Bloomberg.
The UK Prime Minister Keir Starmer says his main opposition, the Labour Party's main opposition, is no longer the Conservative Party. It's in decline, and the choice of voters now in the UK appears to be, and we are miles away from another general election, between the Labour Party and Nigel Farage's right-wing populist party, Reform UK. I think right-wing is something that maybe we should explore in just a moment. This, of course, comes as Farage attempts to woo younger voters, younger British voters, with a Donald Trump-style backing of cryptocurrencies. Earlier this week, the party also called for expanding welfare payments and lower taxes. Again, we'll come on to that in just a moment. It's a fairly confusing picture. So let's get some clarity. Zia Youssef is the chair of the party, owner of the party, and joins us for an exclusive interview. Nice to see you.
Good morning.
Let's talk about crypto first of all. Is this just Donald Trump's playbook? You want a younger demographic, particularly a male younger demographic, to vote for you. It's working very well in the States that you push crypto. That seems to resonate quite strongly. Is that what Nigel is talking about, what he was talking about in Las Vegas with this crypto bill, let's call it, that he would like to put in front of the House?
Well, firstly, we make no apology for listening to young people in this country, which, frankly, the old parties haven't done in decades. Nigel's been very clear that we also need to modernise the British economy and lean into this country's strengths. You know, the City of London, which was once the envy of the world, is still a formidable financial centre, but on a relative basis has been losing ground now for some time. We are being left behind by countries all over the world in things like AI, in things like crypto. So what this bill does is, firstly, it makes it illegal for a bank to debank you or restrict services simply for example, connecting a Coinbase account or legally transacting in crypto. It cuts capital gains tax down to 10% on eligible crypto assets. We'll create a sovereign Bitcoin reserve fund. So we have a Bank of England sovereign fund that is fit for the future. And we'll even allow HMRC to accept, we'll make HMRC accept tax payments in crypto. So we'll make actually paying your taxes frictionless if you choose to use cryptocurrency.
Because there's a lot of infrastructure involved in all of that. Well, are you going to basically force the banks to spend money to make this happen? You're going to force HMRC to spend the money to make this happen? Like, how does that actually, in reality? Because this is great. It sounds very interesting. But you're at the point now, in terms of your polling numbers, where you need to actually be able to justify, quantify how this is going to work and how much it's actually going to cost. So how much would it cost to do all of that? How much would it cost to change the infrastructure for the UK economy to make that work?
Well, this is all going to be significantly beneficial for the UK economy. One of the things I didn't mention there, which is also really important for people watching this show, is that we're going to create a 2-year regulatory sandbox for large firms, especially in the City of London, so that they can catapult themselves into a leading position. So it's not about forcing these firms. A lot of these firms want to innovate. They want to bring some of the best engineers, some of the best crypto people and analysts in the UK, but they struggle because of the regulatory regime.
Some of those sandboxes already exist.
But they've been done extremely half-heartedly and in an ineffectual way. And so in terms of how much things would cost, look, the reality is, if you look at, there's some Chainalysis report that suggests that actually capital gains tax takings from cryptocurrencies are currently actually pretty negligible in the UK.
It's really hard.
Partly because a lot of it is still done offshore. Number two, compliance is very low. And again, this is what we're going to be all about. We're going to reduce the tax rate and we will increase the amount of money coming into the exchequer, which, by the way, if you just look at what's just happened with Rachel Reeves' increase, it was just in the news, I think, this morning in the Telegraph. Rachel Reeves increased capital gains in this country across the board. And what's happening, we're seeing absolute takings for the Treasury come down. So the things we're describing are not going to be a cost on a net basis for our economy and for our firms. They're going to be a big boon for our firms. And they're part of a broader economic package that Nigel will introduce when he's the Prime Minister that will modernise the British economy, get GDP per capita in this country growing materially again.
Nowhere in this bill, though, mentions things like fraud protection, consumer protection. Comparing that to some of the states and some of the measures over in the U.S., there are those elements of it that make it easier to adopt on both sides of the aisle. What's your answer to that? Where's the consumer protection element?
Well, at the moment, there is already significant consumer protection legislation, and that is obviously comes through in other legislation. So what we need to do is make sure what this bill is, first of all, it's not a completely comprehensive crypto program, right? It's setting out it's a statement of intent, and these will be among the first things that Nigel will do as Prime Minister. In terms of needing, quote, both sides of the aisle, our goal, and we're already polling in a position where we would have a reform majority of MPs. Look, we're going to be very clear that consumers will be protected. We're not concerned about that. We will make sure that is done. But at the moment, innovation is completely stifled. Our startup community, how many startup founders are leaving the country? the founder of Revolut, the founder of Checkout, some of the best companies this country has are fleeing this country. If we don't make this country one that is welcome to innovators, where innovation is welcome, not only are we not going to succeed, we are getting left for dead by countries in the Middle East. I mean, look what just happened. Trump went out to the Middle East. Go and look what Abu Dhabi are doing. Go and look at what Dubai is doing. I don't think people in this country realise the speed at which the UK is falling behind. And that's why we need someone like Nigel who's going to say, no, we're going to lean into Britain's strengths, where we have some of the best AI talent in this country. We have brilliant energy scientists. You know, we have the most expensive energy costs in the world, astonishingly, despite actually being a pretty resource-rich country and being home to Rolls-Royce, who have, I think, the best product in small modular reactors, which Nigel will proliferate to the country to get energy costs down.
Let's bring it right back to the crypto story. You've unleashed a series of measures there that you're looking at. Talk to us back to the Bitcoin Reserve Fund that you talked about. What kind of size are we looking at here? How large might that be?
Well, hopefully it becomes very big as Bitcoin appreciates over time. I mean, one of the interesting... Well, we're not going to put a number on it now, and the reason for that is because, look, everything we're doing is taking us in a direction so that, you know, when Nigel wins, which is obviously what we're working on, we hope that reform will become the new natural party of government, which is a moniker that had been previously placed on the Tory party, which I think are now polling fourth in many polls. What we're going to start with is ensuring that any crypto that is, for example, seized as a result of criminal activity and by HMRC goes into there. Secondly, if we make it effortless to pay your taxes in crypto, then that money can go into the reserve as well. But if you actually look at the way Bitcoin has been trading now, it's been really interesting. It's trading much more closely to gold, for example, than it is with tech stocks or other things. So we are seeing something very interesting that is happening. And I think over the course of the next few years and the next decade and the next 2 or 3 decades, which is really ultimately, you should measure the success of a sovereign fund over the course of decades, I don't see any reason why it can't end up being, you know, a pretty meaningful chunk of Britain's wealth.
OK. But at the moment we have our wealth in pounds, and that's our sovereign currency, and that allows us to do lots of things that others can't do within the European Union, for instance, within the Eurozone. Aren't you talking about undermining British sovereignty? Aren't you if we're focused on Bitcoin, that's not our currency. Our currency is the British pound. You're a party that has talked a lot about sovereignty. Aren't you undermining sovereignty, the sovereignty of the UK, by undermining its currency, by talking so much about crypto?
No, actually the opposite. I mean, if you talk about sovereignty and individual sovereignty, our leader Nigel...
National sovereignty.
Well, even national sovereignty. You know, one of the... Look, remember, the bill is not just about Bitcoin, by the way, just to be clear. It's blockchain and crypto assets. The regulatory sandbox we're talking about will allow stable coins. We want to innovate.
People are talking about Bitcoin. Would that be something that you...
Not if it's essentially not if it's a government-sanctioned coin that ends up being the sort of thing that takes us down to...
A government-sanctioned means...
We're in a situation where our leader, Nigel Farage, was probably involved in the most high-profile debanking scandal. Most people watching this will know this, because of his political views. That is totally unacceptable. We are going through a period, and this is one reason why so many young people especially are leaning...
That's a different argument to having a sovereign currency.
No, look, right now, crypto and Bitcoin are an infinitesimal percentage of money throughput in this country. I don't think we're in any risk of the pound's dominance in the UK going away. What we do need to do, though, is encourage innovation, including stable coins, by the way, linked to the pound, albeit not ones which the government can take away from you because they don't like your political views.
If I pay my taxes in crypto, that is undermining that case, isn't it?
Why?
Because you're creating a secondary system through which the government has to operate.
Well, we live in a world where the Trump administration is already going...
I can't pay my taxes in gold.
The Trump administration is already going through... going down this path. Many other countries are going down this path. We can stay stuck in the 1970s if we want, but we're going to get left behind. No one is any doubt. If Nigel's the Prime Minister, the pound will remain incredibly important. The pound will be probably even more important than it is now. But we have to encourage innovation, and we have to allow, frankly, it to be clear to people in this country that your bank cannot debank you or unperson you just because they don't like your political views. And crypto is probably the most powerful hedge we have against that.
Who absorbs the price volatility? If Bitcoin crashes overnight, which happens quite often, who absorbs that? The taxpayers? The Bitcoin Reserve Fund?
Well, the whole point of the Reserve Fund is asset prices can go up and down. But we have a view, Nigel has a view, that in the long run, Bitcoin is going to appreciate. And so far, by the way, as much as it's been volatile, like many assets, by the way, We're not far off all-time highs at the moment with Bitcoin. But look, of course, we're going to be prudent in the way that we manage the public finances. We think, by the way, in the long run, if we don't do this, if we don't have Bitcoin in the sovereign fund in 30, 40 years' time, the country will be far poorer than it would otherwise be.
Can I just talk broadly about where you are? You are a left-wing economic policy and a right-wing social policy party. Ultimately, how do you resolve that tension? Is that a tension that you think you can take into power? Is that a tension that you think is resolvable? Are you a big tent party now that allows all those ideas to exist within your kind of ideological framework?
I think all of these labels are decreasingly useful in the world that we live in today for a few reasons. You know, number one, the same party, you know, the Tory party, that I say, is now polling fourth. They were the ones who talked about fiscal conservatism and living within your means. They took the national debt from $1 trillion to $2.8 trillion inside 14 years and took state spending as a percentage of GDP up to Soviet Union levels at one point in those 14 years. What we're clear about is forget left or right wing. We care about secure borders. We're going to put the interests of the British people first. The algorithm that Nigel will make decisions through as the Prime Minister, the thing he will consider with every decision is this in the interests of citizens of the United Kingdom? If it is, he'll do it. If it isn't, he will not spend a penny of taxpayer money on it.
A penny. Not a crypto, but a penny. Interesting. Zia Youssef, the chair of Reform UK, thank you very much indeed. This is Bloomberg. Friday's upon us. We've got a couple of minutes to go until the start of trade this Friday morning. Let's have a quick history lesson, talk about yesterday's session. Europe rolled over into the close and then kind of bounced along until we got into the close. We went out kind of here. The US market kind of went sideways from there with a little bit of volatility, but nevertheless basically went sideways. The US session, remember, started off quite strongly and then faded. That's kind of where we are this morning when it comes to the futures. We've got nothing really to take us forward. What's the next catalyst? I don't know. But at the moment, the market doesn't see a clear catalyst, as you can see. Like flat, flat, flat. The FTSE 100 up by 0.2%. But basically, we are pretty much flat across the board. Equity futures don't have a clear sense of direction in them this morning. Is that just exhaustion or just not knowing which way to look in terms of where that next catalyst is going to come from, Kriti?
It's fascinating. Maybe today is a micro day after all, even if it doesn't show on the index future story. I'll take it from here when it comes to some of the individual stocks that we're watching. M&G, for example, it looks like Daiichi Life, if I'm saying that name right, to acquire about a 15% stake there from a strategic partnership. That news likely to move the stock higher this morning. But we also got one eye on retail stocks as well. Some of that might come out of the States. We had Gap, we had American Eagle reporting over in the States yesterday, not to mention some of the other retailers. We mentioned Costco at the top of the show as well. That might have a little bit of a flow effect in terms of some of the stocks that trade in Europe on sympathy over in the States as well. And then some deal news on a Friday. Thank God. EssilorLuxottica here buying an eye hospital business, an ophthalmology clinic called Optegra. No terms yet. They're expecting the deal to close in 2025. Unclear, though, what the details around that and the timing around that. One eye on that stock as we go into the open, Guy.
OK, let's talk about how this market is going to open. As Kriti and I both indicated, probably not a lot of catalysts emerging early on in the session, but let's take a look at what the numbers we're looking at are. It's time for the opening trade. Here it is. Let's show you what it looks like. We are expecting a slightly positive FTSE 100, not what we're getting thus far. There you go, slightly more positive. We're expecting to be up around 0.2%, which looks like the direction we are heading in. You have had a choppy week. I think that probably is the best way of describing it. Friday feels like we're maybe coming into the end of the month as well, maybe just breathing a sigh of relief that nothing seems to be driving us in one direction or the other. So the Stoxx 600 is absolutely flat as a pancake right now, as is the IBEX, as is the CAC. The fact that the DAX is open this early and I'm still talking basically tells you that nothing really is going on. You've got the DAX up by 0.1%. You can always tell that. If I've sat down and the DAX isn't open, things are happening. If I haven't sat down and the DAX is open, then you can tell that nothing is happening. It's quite a useful indicator. But that's the picture at the moment, almost exactly as what futures predicted. Basically a very flat open with the FTSE, Kriti, slightly outperforming.
Absolutely. I think slightly is that key word. I love that you just talked about a new market indicator. I'm sure that's how we'll measure volume from here on out. It's fascinating, though. We are seeing a little bit of a mixed market, though. We were talking about a futures picture that was drifting higher. You're starting to see that change a little bit at the open, although I do admit marginally. From a sector perspective, you are seeing a series of kind of, I want to say, defensive tilt in this market. Utilities, for example, is one of your highest from a sectoral perspective. In terms of your weights, you are seeing the technology sector. Again, it just feels like a rotation from yesterday, given that these were the exact sectors that were moving in opposite directions yesterday as well. From an individual stock perspective, I am looking at a lot of French stocks that are taking a little bit of a back seat this morning. Sanofi, for example, is one of them. But then again, some of your outperformers from yesterday are your underperformers today and vice versa, which again tells you everything. But like I said, Sanofi is one that's seeing quite a bit of heavy volume as well. In the meantime, not really a sector narrative in terms of the upside performers, except for the energy story. You are seeing a bump in that sector, and that's perhaps what's behind that UK's FTSE 100 outperformance.
So I'm trying to see why Sanofi's moving. There's some individual drug names data that's been released. I wonder if that's what's causing it. Sam Fazeli could probably tell me what is happening there. But I don't know what else would be driving that stock to deliver what we're seeing there. So I don't have anything useful to say, so I'll move on from that. But basically, this is a market that, as you can see, is largely balanced. I think you've got basically the same number of stocks up and down this morning. There isn't a clear sense of direction, which is therefore manifesting itself at a headline level when it comes to the Stoxx 600. I think individual names aren't providing a catalyst this morning. Sanofi appears to be the only one. I will try and endeavour to find out why.
It looks like, I'll answer that one. It looks like, to your point, there's a gas or a drug that they've got their eye on that met its primary endpoint. So I can't tell you what the drug does.
Is that the reason?
But that is the entire extent of it. But it looked like its primary endpoint in one of two studies. We're still waiting on the other one. I'm not going to attempt to mention the name of this. It looks like a complicated one. But they do have another study coming on, them in line with Regeneron over in the States, assessing that data with regulatory authorities. So there is some delay potential baked into that. But the primary endpoint tends to move those biotech stocks as well. So we're going to keep one eye on that. In the meantime, we did mention that there was plenty of economic data across the board. We are starting to get an early trickle of that over in Spain. The preliminary May harmonized CPI rising about 1.9% on a year-over-year basis. The estimate there was about 2%. So slight underreaching of that metric, but not enough to really move this market. Again, it is that Friday energy. Let's bring in an expert who can perhaps weigh in on what we should be paying attention to. I'm pleased to say Delphine Arnaud, multi-asset portfolio manager over at Edmond de Rothschild, joining us this morning. Delphine, rescue us, if you will, from this sleepy market. But talk to us a little bit about how perhaps we should be thinking about some of these trade narratives, the monetary policy that follows. For you, what's driving the next leg of market moves?
Hi, Chris and Kriti. For now, what we are waiting for today, for instance, is the numbers for the expense the income in the US. What we've seen yesterday, and it drove the rates lower. It was the jobless claims and the continuous in claims and the GBP revisions. So the question yesterday was less about the tariff. It was always a part of our question, but it brings another question in the room, which is how fast is the slowdown of the US economy? How fast will be the slowdown in the job market, and how the consumption will be impacted by the uncertainty and the tariffs? And also another element is the student loan, which where we see increasing delinquencies.
Talk to us a little bit about that. You talked about the economic resilience over in the States. What about the economic resilience here in Europe? Does that even matter, or is it really a reaction function to what's going on stateside?
In Europe, the consumer have been very shy for the moment, and we've got the retail sales today in Germany, and it was pretty shy, and our view is that in Europe. Now the real income are increasing as the inflation is no longer is no longer a problem for consumers. And they still see wages increase. So the European economy can rely on more robust consumption, but for the moment we don't see that. And the key points here that we've seen a rebound of the consumer confidence, but it's really shy for the moment. And we have to admit that in Germany, the manufacturer sector relies a lot on China and US consumption, and for now it's been very muted on that part. So it waits on consumer confidence and investment confidence. That's just a temporary slowdown, and our view is that thanks to a new momentum in Europe, it will increase. But and thanks to fiscal support also in Europe, it will increase. But we have to wait for next year.
Do you think that we're going to see a stronger euro from here? What happens on the currency front? Because a lot of investors are talking about the impact that the currency is having right now.
Yeah, on the euro have been strong, or we should say that the dollar have been weakening for quite a few weeks now, few months. Our view on euro is that the euro always gain force when there is a political partnership between France and Germany. And now that's a scenario we are seeing currently. Also, we are seeing euro stronger thanks to a new support from policy, European policy governments toward more fiscal support, and that's good. More innovation supports and simplification of rules. That's always good for the economy, and that can push the euro higher. What we see is that the ECB has been supportive with rates more than the Fed, but it didn't really impact the euro. And currently, the yield rate differential is no longer a driver for the moment for cross-currency pairs.
Delphine, we're going to leave it there. Thank you for joining us this Friday morning. We really appreciate it. Delphine Arnault, multi-asset portfolio manager, joining us from Edmond de Rothschild. This is one of the things I'm certainly taking away from today's programme is the importance of what happens next with the currency. And you got Jeff Yu kind of suggesting maybe there's downside risk in the euro if the tariff story or we get stability, at least in terms of the transatlantic relation, then maybe actually you could see a lot of the money that's flowed into the euro coming out. You push the euro higher, you go the other way, and it changes the arithmetic quite significantly in terms of where I think investors, particularly out of Europe and Asia, are going to be parking their money.
I think what's fascinating for the FX piece is because of this dollar decline, this is a positioning story. But the fundamentals you use to make your FX forecast right now, interest rate differentials, terms of trade, economic resilience, rate paths as well, none of that is consistent at the moment to the point of that you're looking at a bond market that is more perhaps driven by deficit concerns in various parts of the region that don't necessarily have an immediate bearing on the FX story. It really is a positioning. It really is narrative. And you can't get a handle on that.
But there's a funding story. Is the rest of the world going to continue to fund the United States, which feeds back into the kind of the deficit story? Can the Americans continue to afford such a large deficit if the rest of the world doesn't fund it? And I think that's kind of the bigger question. And that takes us back to the story, the tax story we were talking about at the top. In theory, the euro shouldn't be doing what it's doing right now. In theory, US rates are staying high right now. In theory, European inflation, or just been Spanish inflation, ticking a little bit lower. In theory, that should lead us to a situation where actually you have a strong dollar. But that's not happening. So something bigger is therefore happening to overcome that kind of mathematical story around what interest rate differentials should be delivering, and that is uncertainty. That's the bigger concern right now.
But that dislocation, and if historically you look at that, when the dislocations don't make sense like that, the snapback can be fairly violent snapback. So I think that's the risk that a lot of folks are having when you say this is the kind of where we're having this bullish. Sorry?
This is permanent.
Yeah, well, this bullish euro moment, and then suddenly you have a deficit concern in France and Italy and Spain and even right here in the UK, and you have to reverse very, very quickly. And I'm not saying that kind of undermines the weakening that we're seeing in the States, but it certainly does perhaps change some of the math and the volatility and the risk that you're taking on, compounding the uncertainty you're talking about.
And the other question around that is, I think Jeff was talking about what level do you need the dollar to be at so that people are comfortable funding U.S. assets? Is that the kind of the release valve? But if European currencies get stronger, the opposite works in so many ways. Anyway, it's maybe one to continue the discussion into next week with. Let's talk about the core six this morning. Let's figure out exactly what is happening here. Not a lot of price action, as you can see, across the board this morning. Pharmaceutical stocks are under pressure, which is maybe something that is worth paying attention to. Everything else looks pretty much in the red. Tech has definitely rolled over. Let's get the individual stock moves and figure out what was happening with Sanofi. I think Joe is going to be able to answer that question for us.
Well, I'm going to do my best, Guy. This does look to be related to some trial data that we've got out of Sanofi, as you guys were mentioning a moment ago. Now, Sanofi trialled a drug that was treating lung illness, kind of similar to asthma, in former smokers, and that result came out in terms of the trials. There were actually a couple of trials within that. One of them looked positive, but I've been messaging analysts this morning, and they are saying that, in fact, the results of the other one, the second trial, actually disappointed. Exane analysts saying it was not the blockbuster knockout result that they were looking for. This drug expected to have almost 5 billion euros of peak sales when it comes to market. So this is seen as a significant negative. So that result, that trial result, weighing on Sanofi today in France, and that is one of the biggest decliners by points. It is, in fact, the biggest decliner today. Then we've got M&G, much more positive. This deal coming through with Daiichi Life over in Japan. Daiichi Life taking a 15% stake in the company, and also we're going to see around $6 billion worth of flows coming into the UK company, and they have seen a lot of outflows in terms of equities over the past couple of years. So that is seen as a big boost. M&G, we're up almost 8% on that one today, a decent move higher. On the M&A front, then we've got a little bit of weakness coming through in some of these clothing retailers. H&M a little bit soft, as is the Zara owner Inditex. Remember, we got these results out of the US yesterday. Gap down 15% in the post-market. A lot of that, though, seemed to be related to the Banana Republic brand, although the actual Gap group sales missed expectations very slightly, according to some of the analyst reports I read at least. We're seeing Primark holding up in terms of AB Foods, next steady as well, but a little bit of softness coming through into the Zara owner, in particular Inditex. Down very slightly today. Then we go over to yogurt and bottled water, a deputy CEO change over at the company, standing down the deputy CEO, Grant, leaving to pursue another opportunity. That stock has outperformed, so only a little bit of weakness in that one, not a huge move. But Danone in focus on that change. Then NatWest, it's going to be an end of an era when they sell, the government at least sells the remaining stake of the company that it bought out back in the financial crisis. Of course, we know they were kind of selling that down, but the latest report coming from Sky that this shareholding could actually end today. So, as I say, a bit of an end to an era on NatWest, formerly known as RBS, of course. And then finally, a bit of a broke move in the UK in financials, a double upgrade for Exane. I'm mentioning Exane for a second time today. Hiscox, it's easy for me to say, rising around 2.9%. The insurer doing well in the US and also in UK retail. So we love a double upgrade, and that one is rising almost 3% for Hiscox in UK insurance today.
All right, Joe Easton from our equities team, we thank you so much walking us through those individual movers at the European Open on this Friday. Coming up on the program, the legal case against Google's search dominance heading into final arguments. We're going to dive into the case and how it's already changing online searches. That conversation next. This is Bloomberg.
Friday morning, Kriti's talking about kind of Friday vibes, quiet Friday vibes. I think actually maybe she's right and I'm wrong. Let's take a look at what we're seeing in terms of the story when it comes to European equities. Nothing to see here. FTSE's up a little bit, not by much. French market under a little bit of pressure. I think Sanofi's a factor there. In terms of the sector breakdown, this is what you're looking at. Real estate's up, insurance is up, utilities is up, groceries are up. That is a defensive market, folks, just in terms of what you're seeing. The yield story is a factor. On the downside, basic resources, technology, retail, and the car sector. So I think actually that there's something slightly you can read into the sector picture that we are seeing. Feels a little defensive, feels a little maybe the Friday feeling. Just looking for a safe trade going into the weekend.
I love that you said Kriti's right and I'm wrong. That's going to stay with me forever.
Just clip that.
I'm going to clip it. We're going to play it on loop. It's going to be our intro.
It's going to be
everything.
Message nines from now on.
Well, you know who else has, I'm sure, a take on that is our Marcus Live executive editor, Mark Cudmore, who I'm sure also agrees that Kriti's right and everyone else is wrong. Mark, walk us through these markets here in a few minutes, if you can, and simply about what actually is the next catalyst. Are we waiting for the trade story out of the States? Are we waiting for monetary policy out of Europe? Where do we go from here?
Well, first of all, Kriti, of course you are right. I just disagree that everyone else is wrong. I do think that it is a quiet Friday, but as Guy says, the sector divide in the equities shows there's a bit of a defensive feeling. And it was interesting even yesterday how poor the kind of price action was. We've kind of had until yesterday's data, we've had a pretty good run in the last couple of weeks. Generally in risk assets, stocks have done well. We've now seen yields come back off their highs, should be supportive. Until yesterday, we've had a pretty good run of data, some okay earnings. And yet the price action now has really run out of steam over the past week, and I think that's a bit worrying. So I think to go to Guy's point about the sector divide in equities, I think people are kind of using this better kind of rally in stocks over the past week to actually kind of de-risk a little bit. I think we're waiting for the next catalyst. And this goes back to the story we keep on saying on this show over the last couple of weeks, that the longer term 2025 trades are very clear and they've been working well. They'll continue to work well. But I think the shorter term direction, we're really wondering how to trade this environment, because we think that the trade war damage, no matter what happens in the trade war from here, won't really show up until June in the real data, which means we don't get those releases until July. So what do we do to them? We're kind of in limbo.
Yeah. There's plenty of nice places to visit in Europe, I would argue. Let's talk about what that price action is telling us. You've been watching crypto as a price signal. Also the fact that, and Cameron's been writing about this as well, markets tend to roll over on good news, not bad news. Is that now what we're seeing?
Yeah, I think that's a really, really valid point, because, yesterday, the fact that Trump's trade war is being challenged. We don't know what's going to happen. Of course, he's appealing it. It's going to go to the Supreme Court. There's talk about workarounds. But the fact that it's even being, blocked initially by the trade court should only be a positive news. But the price action was kind of very disappointing yesterday. So I think that is true. Markets tend to bottom on bad news. It's the day when you get really terrible news, but it can't go any lower. And similarly, you can't get any higher when we get really good news. So I do feel that it's like we're going to roll over, but I'm just not sure what the really negative catalyst is from here. There were a few marginal leading indicators. There were negative. Claims is ticking up, but I'm not expecting non-farm payrolls to be terrible next week. Crypto price action is very disappointing and poor, but again, it's not a catalyst in its own right. Shipping data is flagging a warning, but again, a few weeks away before we see that data.
A bullish Mark Cudmore. I feel like I've seen a unicorn on this program. Mark,
is he bullish? Sorry,
I don't know.
I'm not sure that sounded that bullish.
He said things are in limbo. He said there isn't necessarily a negative catalyst. I'm going to take it. I think you've got to take a bullish Mark Cudmore when you get one. But Mark, very quickly, talk to us about whether or not we can trade some of these deficit headlines, because I think there's been this real tension between tariffs, deficits, etc. Which matters more for the next leg of gains or declines?
I think tariffs remains the short-term tradable theme. Deficits is the longer-term story.
Okay. In terms, therefore, of how we should... This story about the fact that we're going to be seeing foreigners potentially being taxed in the United States if they come from countries that have a digital sales tax, for instance. How many more headwinds do foreign investors into the United States need before they wholesale go... Actually, the marginal dollar doesn't go in that direction? Are we already at that point?
I think we've been at that point for a few months. And I think, that's the general theme. But again, this is not a panic. It's about just reducing exposure to the US. We've seen that. We've seen that for the last few months. And this is going to be an ongoing theme. We're seeing US assets underperform, and that's the case. And actually, Kriti, I push back about the roundest bullishness. I was bullish all last year until December, and I still remain very bullish, not very bullish, but bullish global stocks. Absolutely. I am just that US stocks are going to underperform and US assets are going to underperform. And I think, to answer your point, Guy, we've already reached that point where the world's gone, hey, wait a sec, we traded the US outperformance for 15 years. We traded it aggressively. It was a wonderful theme. It did really well. It went way beyond many people expected, including myself. But now we've reached a tipping point. That tipping point was reached at the end of January, and we're seeing that as a valid theme that's going to be an ongoing theme. But it's not about a panic outflow. It's just about, hey, we're going to stop rolling over some of our returns. We're going to slowly decrease that exposure.
Okay. Almost like bullish.
Kinda.
But everybody else's stocks, not America's stocks.
We'll take it. Okay. We'll take it. It's a win.
Mark Cudmore, thank you very much indeed. Remember, you can catch up with Mark and the rest of the team. It's been a fantastic week of coverage on the MLIV blog, I have to say. MLIV Go on your Bloomberg terminal.
Absolutely. Let's go to the other major story happening out of the States, having international effects. Google and the U.S. Department of Justice slated to offer closing arguments today in an antitrust case that caps a busy spring of litigation over the size of big tech. Charlie Wells is here with the latest. Charlie, this has been going on for a while. Why do we care?
So look, the risks are mounting for Google, and they're mounting more broadly for big tech. And we care because in less than 1 year, Google has been found to be a monopolist in two significant parts of the internet, in search and in advertising, by different federal judges. And so we're at the point today where we're getting to the remedy phase, where we're in the remedy phase, where a judge will decide how to rectify the search front. And basically, the Department of Justice has been very aggressively arguing in favor of Google having to split off Chrome. Google, of course, has been arguing against that. The CEO, Sundar Pichai, talked about how, this could have unintended consequences. There's the issue of innovation that's been coming up. But another reason why we should care is AI. And if you've been listening to some of the questions that this judge has been asking over the course of these hearings in this remedy phase, it's been about AI, because search is kind of backward looking. But there is this concern that these big internet giants could use the dominance that they have in search and continue it throughout the AI that we're seeing going forward, the AI technology.
Near term, what happens with this case? What are people talking about? What is the expectation? Are we going to get a breakup? I guess is the question I'm asking.
So history does not bode well for a breakup. The last time that this happened successfully was in 1982 with AT&T. We all remember the Microsoft trial from 1998. That was ultimately unsuccessful.
I remember that. I witnessed it, sort of. Charlie Wells walking us through the latest with the Google case. It certainly is one. It has ripple effects because it just takes one to kind of break the camel's back, and then it has precedent for all the others. That is something you could trade, and that was tradable in 1998. We thank you so much. Coming up, we're going to switch sector focus. Oil prices declining ahead of a crucial OPEC Plus meeting this weekend. We're going to get the latest with the CEO of Crystal Energy next. When you look at Brent price right now, we're looking at a 64 handle, NYMEX at 60. This is Bloomberg. This is the opening trade, about 30 minutes into today's session. We are seeing some green on the screen here, but look, light volume, light liquidity. The DAX is your outperformer this morning, higher by 0.4%, right alongside the FTSE 100. Your underperformer is France, though. Some interesting individual names, I think, driving that market lower. Sure.
It's definitely one of them. Luxury stocks are also under pressure, worth bearing in mind, but Sanofi looks like it's certainly one of those. Let's talk about what is happening in the oil market. Oil is on track for its second weekly decline ahead of an OPEC Plus meeting that is going to debate output policy. It's expected to lead to another supply hike, i.e. more crude, coming into the market. Carol Nachler, founder and CEO of Crystal Energy, joining us to discuss. Carol, is that what we should expect? Are we about to see even more oil coming onto this market?
I think this is a consensus among the various market observers and analysts. It's not a question of hike. It seems everybody's expecting a hike, but how much, how many barrels is OPEC plus, or particularly the group of 8 countries who cut a year ago, 2 years ago, around 2.2 million barrels a day of voluntary cuts, and they decided to start unwinding those as of April. But then, so they set a monthly schedule, but then in May and June, they tripled the amount that they originally said they were going to put in the market. So they went to 410,000 barrels a day instead of 140,000 barrels a day, or just around that number. And the expectation today for most observers is that OPEC can get away with another tripling of its production increase plan, because look, they did it in May and June. Everybody said they were going to crash the market, the price is going to collapse to 40 or 50, and that did not happen. So I have the feeling they are going to stick to tripling again the monthly hike and go to 411,000 barrels a day. And that means that by the end of the third quarter of this year, they would have unwinded all the voluntary cut of 2.2 million barrels a day if they stick to this plan.
Carol, everybody's waiting later this year for the trade story, the trade war that's happening, to have an impact on economic data, to have an impact on demand. The global economy is likely to slow. Is that what happens with the oil price, with all these extra barrels coming on in July and August and September, when the data's starting to roll over? What do you think the price reaction is going to look like at that point?
Ironically, I mean, first of all, it's very difficult to predict where prices will go with so many moving parts happening, both on the demand side and on the supply side. And there I want to bring in the geopolitical situation. But when you look at the demand side, it's true. I mean, tariff wars are bad news for the global economy, full stop. And as a result, that would impact negatively the growth in oil demand. But so far, we have a period of tariff truce, though it's not tariff peace. And until we see peace, we're going to continue to see this kind of nervousness dominating the market. That said, we are heading into the holiday season, the driving season, particularly in the US, the largest economy in the world. And that could put an upward pressure on demand and therefore could support prices. So tariffs are the big unknown on the demand side. But on the supply side, it's not that we're going to see like exactly 2.2 million barrels a day, barrel for barrel, added into the market, partly because some members are overproducing and other members within OPEC Plus have been struggling to increase production. But also, we're going to see also some perhaps deceleration in US production, particularly with shale, which is very responsive to oil prices. We don't know what's going to happen with Russia and Iran when it comes to potential sanctions and maximum pressure on Iran. And we saw President Trump is getting a bit, is losing patience with President Putin. So all these taken together may actually mean that we're not going to see a very different picture from where we are today in the coming months over the summer.
Well, Carol, it's interesting that you mentioned that, because of all the factors that you're talking about that could sway the pricing. We're fairly pretty range bound when it comes to, I'm just going to use Brent crude as that kind of 60 to 65 window. We haven't seen it vary from that. I'm curious, from a macro investor point of view, are you seeing fund flows that are maybe looking at the volatility around the world and saying, actually, maybe the commodity space, maybe oil right now, is the stable asset to own?
You know, it's difficult to say stable, because stability is a big word in oil markets and any global commodity markets, because volatility should be the norm. So that's why one question I always raised when OPEC talks about stabilizing the market, and actually in their latest communique, they said that they are committed to maintaining stability in oil markets. And the question that I raise is stability at what price? But it seems that today that this range bound that you mentioned, 60 to 65 for Brent crude, seems to be the range that everybody is happy about, including President Trump. So even when people refer to shale producers facing big burden and some may stop producing, that may be true to some producers, but also the shale is very diverse. You do have people still making a lot of money because they do have a break-even oil price of $40 a barrel. So we might continue to see that stability, but again, we might see spikes depending on what happens with geopolitics. But I would really not call oil markets as stable, because it would be rather abnormal to see stability in oil markets.
Talk to us a little bit about market share here. I mean, you made that point that everyone is perhaps happy with that $60 to $65 range. Donald Trump certainly seems to be, especially given the fact that we're not kind of at hitting those break-even levels yet, which makes shale perhaps unprofitable. But I don't think I can say that for the same players in the Middle East, Saudi Arabia, the UAE, et cetera. How long can they sustain that level before they get antsy?
They can sustain it for a long level. First of all, I mean, these are very big producers and they have very low cost of production. And people raise question about the pressure of low oil prices on their economy. It's primarily because these are oil-dependent economies. So they need certain high price level, and for different countries, different price level. But I think for Saudi Arabia, between $80 to $90 a barrel to balance their budget. But this does not mean that their economies cannot function with budget deficit. They can finance the budget deficit. Of course, they are facing a higher debt and a public debt, particularly, for example, the Kingdom of Saudi Arabia, but that could also translate into axing some projects, very ambitious projects, or delaying some projects. So it's not that they are immune, but it doesn't mean that they are going to collapse. And mind you, some countries in the Middle East, for example, Kuwait and the UAE, they have massive sovereign wealth fund that help them to cushion the impact of low oil prices. I am more concerned about countries such as Iraq, for example, or let's say in North Africa, Libya and Algeria. These are OPEC members that they may have low cost of production like Iraq, but they have huge dependence on oil revenues, and their economies are much more fragile than the other Gulf countries.
How do we plug in a weakening dollar to what is happening with the oil market? How do you think people should be thinking about that? If the dollar continues to weaken, oil is priced in dollars, at least for now, what effect could that have?
Well, it depends on the trade partner, right? I mean, usually oil is traded in dollars, although there were some attempts. Some people said, oh, they were going to use another currency, but we saw the reaction of President Trump. But definitely this might boost the sale of U.S. products, and that can improve the balance of payment for the American producers and exporters. But that may also mean bad news for other countries who are pegged to the dollar. So the impact of the dollar on the countries is difficult to generalize because it depends on the situation of different countries and the relationship to the dollar, whether their currency is pegged to the dollar or not.
Carol, what are we missing here in terms of sanctions when it comes to that sanctions risk out of the United States and arguably even in the EU on Russia? Is that something that needs to be priced into this market?
It is a concern, but we are not seeing yet an impact of sanctions, tougher sanctions. So let's clarify this. So there have been sanctions on Russia since 2022, and those sanctions were tightened over time. But still, Russian oil did not get out of the market. We saw a redirection of trade flow. So we did not have supply disruptions. What's going to happen next, I don't know, and I don't think anybody can tell. It depends. We saw President Trump recently losing patience with Russia, with President Putin, because originally, remember when President Trump during his election campaign said that he could end the Ukraine war in one day. That has not happened yet. So what kind of sanctions can he apply on Russia if there is no deal anytime soon? And how effective those sanctions are going to be, I don't know. We might see some loss of barrels coming from the market, out of the market, but I don't think it's going to create a supply shock that many may have been concerned about, say, in 2022. You see, one thing we learned about sanctions from the history, whether with Iran or with Russia, when they are not applied by all countries around the world, then their impact is likely to be limited. And this is what Iran has told us. Their barrels are still flowing in the market despite the sanctions, decades of sanctions on Iran.
All right, Carol Nachle, lots to digest there, founder and CEO of Crystal Energy, giving us the worldview when it comes to what's driving those oil prices. We thank you so much for joining the program. Coming up, Spanish inflation cooling slightly more than expected. We look ahead to Italian and German CPI due out over the next few hours. We're also going to get details ahead of next week's ECB meeting, maybe how they're thinking about the headline risk. Stick with us. All of that ahead. This is Bloomberg.
The circumstances are, of course, that even with this agreement, we're still going to have tariffs that are higher than they were before all of this started. So, that's something that we have to bear in mind. And the second thing we have to bear in mind, and it goes back to the points I made about, economies like the UK and Ireland being as open as they are, is that, of course, the UK-US trade agreement is important, but what the rest of the world does is as important.
We live in an interconnected world, basically, and the tariffs are going to be higher than they were before. The Bank of England Governor, Andrew Bailey, there speaking to Bloomberg's Francine Lacroix last night, I think in Dublin. Let's talk about what is happening with the tariff story more broadly, because obviously the legal aspect of all of this is getting quite interesting. So a federal appeals court has temporarily blocked a ruling that threatened to throw out the bulk of President Trump's tariff agenda, or a significant portion of it. Despite the reprieve, the possibility remains that the appeals court could ultimately back the original decision and block it, which ultimately probably means we're heading somewhere towards the Supreme Court. Bill Ferris joins us now to discuss. Bill, is that ultimately where we're heading here? Is it the Supreme Court? Is this going to ultimately end up with the justices having to make a decision on whether or not it is Congress that ultimately has the kind of the final word when it comes to tariffs, or whether the president actually has some of that power delegated and can use it kind of willy-nilly how he wants?
Yeah, I think some sort of an appearance at the Supreme Court is very likely. The White House, of course, celebrating this decision by the appeals court to put a temporary stay on that decision, which had just a day ago had really wiped out most of the tariffs that President Trump had put in place after taking office. So that was the 10% baseline tariff, all those fentanyl tariffs against countries like Canada, Mexico, and China. But in the end, no one knows how the appeals court is eventually going to rule. If they side against the administration, the White House will take that case to the Supreme Court. If they side for the administration, the plaintiffs are likely to take that to the Supreme Court. And so the bigger issue here is, what does it mean for the ongoing trade negotiations? Does it mean the administration will have to find another way to raise revenue besides tariffs? That's unlikely. This is a very pro-tariff administration. If they can't use this provision of the law to get what they want, they do have some other tools within the scope of the law that allow them to raise tariffs. They're just not as convenient, and they could be subject as well to some backpedaling by the courts.
So, Bill, what does this do from an international perspective then? You're sitting in Asia. We had Treasury Secretary Scott Bessent saying those trade talks are stalled. Are they likely to remain stalled if the legality of the tariffs remain in question?
Yeah, so, we've got a whole range of negotiations going on, not just China, but you've got India, Japan, South Korea. Those conversations are taking place. We're in the back half of this 90-day pause on tariffs. So you start to wonder, is that 90-day pause going to get extended? If you're a country going into negotiations with the U.S. on a daily or weekly basis, you do start to wonder if maybe you can harden your position a little bit, if maybe the White House and the administration have a little less leverage behind them, given these recent court rulings and setbacks. But in the end, again, this is an administration that's dedicated to tariffs. It's counting on the revenue from tariffs to help offset some of the tax cuts it's proposing to make in its budget bill. There is not, Peter Navarro said it pretty plainly. He said there is no plan B, there's only the plan A, and that plan A is tariffs. And that's, I think, the position they're going to hold for a while.
Bill, can you just give us some insight into what is happening with the big beautiful bill and the tax implications of it, particularly for foreigners? Section 899 seems to be making headlines this morning. The idea that ultimately foreign investors from countries that have things like digital taxes could face higher withholding taxes effectively on interest and dividends. What do we know about this? Is this something that people expect to be thrown out by the Senate? Could this become a reality?
Well, it very much could become a reality, and it is drawing a lot of attention, because if you are a foreign investor running a sovereign wealth fund, a company with big investments in the U.S., like in U.S. Treasuries, for instance, you could face a different tax regime. You could face a higher tax than people from other countries that the U.S. has a better relationship with on the tax front. So you mentioned the digital services tax. That's something, that affects, it's in place in the places like the EU and Canada. Could this get through the process? This bill that passed the House is definitely going to face changes. The Senate Republicans have already made that clear. There's a lot of things they don't like. There is, however, within the Republican Party, a fair amount of support for this measure. It's called a revenge tax. It would give the White House leverage in some of its negotiations. So there's still a lot of steps in this process. The Senate's going to make changes in the bill. This might or might not be one of them. It is just too early to tell. And then that has to go back to the House for approval. So we're still a ways away from that big, beautiful bill becoming law. But this is suddenly drawing a lot of attention because the implications are so large for foreign investors.
And really magnifying and capitalizing on a moment where so many foreign investors are already looking at the states and saying, do we want our money there? Bloomberg's Bill Ferry is walking us through those dynamics out of D.C. We thank you so much. Plenty of data in the meantime to keep us company on this Friday. Let me walk you through it. At 10 a.m. UK time, just over an hour from now, we do have Italian inflation hitting the wire. We just heard Spanish CPI coming in slightly below that 2% expectation. At 1 p.m. UK time, we do have those Germany inflation numbers. The regionals coming in the next hour. So we'll see how that all pals together if it moves this market. And then later in the day, the focus, of course, is going to be on the states. U.S. personal income and spending data plus that U.S. PCE. We'll see if that kind of shows some cracks in that resilient story. In the meantime, let's put our focus right back here to Europe. Well, as I mentioned, Spanish inflation has eased to just below the European Central Bank's 2% target, backing the case for interest rates to be lowered again next week. But will they? Let's bring in Bloomberg's Ben Sills from Madrid to walk us through it. Ben, pleasure to have you on the program. Happy Friday. Walk us through these numbers. What would the ECB be thinking when those numbers cross?
Yeah, the ECB is going to be pretty pleased to see this. The economists we surveyed were expecting it to come in bang on 2%. The ECB target came in at 1.9, so that's a positive signal. We're now looking ahead to Italy at 11 o'clock our time, and then Germany, and then the Eurozone number, which is next Tuesday. All of that kind of like builds up to the ECB meeting next Thursday, where we're expecting the policymakers to cut rates again for the 8th time.
Ben, the noise that I'm getting out of the ECB, though, is that there is a sense that we need to get more information before we make some of these final decisions in the rate cycle. The last couple of cuts, do we wait until after the 90 days is done? Do we get a better understanding of what the inflation data looks like with the potential implications of that trade story on the inflation data going forward? Is there a sense that maybe the ECB does hit pause for now?
Yeah, I think that's right. We're expecting a rate cut next week, but after that, the next meeting isn't until the end of July, and that is after that 90-day pause ends. So they'll have a lot more clarity on where we are in the tariff situation by that stage. Our survey out today of economists suggests they're kind of on the fence about whether we will get a pause in July, but they are expecting that by September there will be like one more rate cut, bringing us down to 1.75 for the deposit rate, and that the ECB is then going to sit there till the end of next year.
Okay, Ben, great. Thanks for the update. Really appreciate it. We're all agog with anticipation, trying to figure out exactly how this is all going to work. Some clarity would be nice, but that seems to be in short supply. Ben Sills joining us on the latest surrounding the ECB. Next week, busy week for both of us.
You and I are going on separate adventures on two different parts of the world.
Yep.
I'm heading to Berlin. We're going to Super Return, largest private equity conference in the region. These are just some of the guests we've got on the show, which I'm really excited about. Look, we've been talking about this idea of American exceptionalism coming to an end. Well, the juiciest deals right now in private markets are right here in Europe. We had this conversation with KKR this week. We had it with EQT last week as well. We're talking to the folks who manage, combined, over $2 trillion in private markets. So really excited to have those conversations exclusively to Bloomberg, Apollo, Vista, General Atlantic, Neuberger Berman, among a series of others.
So what is the key question you need to get out of it? Is it on exits? Is it the ability maybe to offload some of the assets that they've been taking on board? Because that appears to be the dam at the moment in this market. Is it ultimately the economic outlook? Are they looking for a more positive economic outlook? Do they think the economic outlook is stable enough to invest in? What's the macro picture they think they're working their way towards here?
All of the above, but I think the one that's interesting to me is that 2025 was supposed to be the year of deal exits. And a lot of the bigger companies like the KKRs can navigate it because they're sitting on a larger pool of capital, have a little bit more flexibility. The scale really comes in handy. Here's what no one's talking about just yet in scale is simply that if you have the news coming out of Harvard, Yale, et cetera, where you're starting to liquidate those long duration assets, you suddenly have a series of deals that are on the table. Does that drive valuations lower? That's kind of the questions that I want to be asking them. But I'm not just traveling. You're traveling, too. You've got, I would argue, a busier
72.
Yeah,
and
Sunday,
more
Sunday,
hours.
Monday, Tuesday, going to be quite busy. So my theory is always, if you want to know what's happening in the global economy, you ask an airline CEO. And so I'm going to go to IATA, which is where all the airline CEOs will be next week. We're going to be in New Delhi. Peter Elbers, who runs Indigo, I think, which is the third biggest airline in the world, is going to be hosting us there. We're really looking forward to that. So you ask an airline CEO because they know a lot of things. Okay, they know a lot about what's happening with the consumer. They know about the low-end consumer. They can tell you what's happening at the back of the plane. They can tell you what demand looks like there. How price elastic is that? What's the picture looking like at the front end of the plane? Are US travellers continuing to travel? What's happening on the North Atlantic? What effect is the dollar having in terms of people's perceptions of whether or not they want to come to Europe? There's been lots of Americans in Europe over the last few years. Does that start to dry up as the dollar becomes a little bit cheaper? What happens there? What's happening with the fuel story is another significant factor. Like, American airlines aren't hedged. European airlines are hedged. Lower prices of fuel, how does that impact their ability to lower prices, maybe to continue to drive demand, and what's happening there? What's happening with the infrastructure story? In the US, you've got issues with airports like Newark having huge problems. Here in Europe, you've seen what's happened with Heathrow, with the need to invest. There's an AI story that comes off this as well. These airlines are backward generally. Yeah. In their technology story. Are they folding AI in? What kind of an impact? So there's so many things you want to be... to an airline CEO, you want to know what's happening? You ask an airline CEO. And we've got a whole range of them. I think we've got, from one end of the world to the other end of the world, we've pretty much got it covered. So I'm really fascinated to see what they all have to say. What I'm interested to see is the lines that we draw between them all. Yeah,
it might be a very different story. I believe you've got Delta coming up as well.
Ed Bastian, we've got Ed Bastian on Sunday into Monday. That's going to be interesting. IAG, we're going to be talking to IAG. Got Air France, we're going to be talking to them. Got loads of the Asian carriers as well. What are they seeing? Is it a different story? So we've got it covered.
So you and I are gearing up for a busy week. I think everyone is maybe slowing down a little bit. The Friday Energy, they were talking about a couple things happening over the weekend. We've got the Spanish Grand Prix. If you're feeling,
I hope it's going to be more exciting than Monaco, because Monaco was really boring. So I'm looking forward to that. You can do the next one.
I never hopped on the car situation.
Not me, but if you're going to watch a Grand Prix, Monaco looks really pretty, but not very exciting. Champions League final, though, that is going to be exciting.
Yeah.
Can the French finally win it? I think is probably.
Are you going to be tuning in from New Delhi or from the plane?
No, but I know my children are quite excited about it, so I'm going to miss it. But my children are going to be definitely tuned in.
Absolutely. There's plenty of going on over the weekend. Don't miss the new edition of the Bloomberg Weekend Newsletter. You get more deeper analysis, feature pieces, profiles on that unique insight. Stick with us. This is Bloomberg.